Kirti. I'm a managing principal at Clifton Larson Allen. We're a Big Eight accounting firm. I'm based out of New York. I also have the privilege of leading our global services practice, so helping any clients that have cross-border business or cross-border transactions. We help them every step along the way. Excited to be here, and I think I'll pass it over to you, Sarah.
Great, thank you. Good morning. I'm really excited about the conversation this morning. My name is Sarah Moreno. I'm with the U.S. Department of Commerce, U.S. Commercial Service. My little logo up here in our big event that we're hosting next month. I'm in Lexington, Kentucky, and I help Kentucky companies export, basically. We are the U.S. Department of Commerce, so we have a worldwide network in support of U.S. exporters. So that's in a nutshell. And let's see, I'll pass the baton to, how about Julie Ashmore.
Good morning. This is Julie Ashmore. I'm with Ashmore Consulting. Sorry, I'm not showing my face, but I'm mobile, so I don't want to distract from the conversation today. But I'm with Ashmore Consulting, president and CEO. We're a full service advisory firm. We assist corporate clients in site selection, tax credits, and incentives as they expand, relocate, or consolidate. Thank you.
Julie, are you based out of Kentucky?
I am based out of the Indianapolis region. Okay. Indianapolis, Indiana.
Very nice. Good to have you. Mary, you're next.
My name is Mary Niekamp. I work at the Kentucky Cabinet for Economic Development in KY Innovation, and I am the program manager for the State Trade Expansion Program. So I have the great honor of working with companies to help them learn to export and to basically scale their business so they can grow through international exporting. Glad to be here.
Okay, we have Edis as a guest.
Good morning. My name is Edis Selimovic, and I am an owner-operator truck driver, and I would consider myself a student of international trade. And I'm here just hoping to learn a little more about international trade, and I am a resident of Louisville, Kentucky.
And last but not least, Charlie Ann.
Good morning. Can you guys hear me?
Yes.
Okay, I apologize. I've been having some difficulties as well. But I'm in the same boat as Edis. So I have been in banking, more in the business banking space with US Bank. We had a heavy focus in manufacturing. I've just recently started a new career with Fifth Third in the middle market space. And I really want to focus on manufacturing, several reasons. But I think it's a huge importance here in Kentucky. I think Louisville is a great market for it. And I think there was some lack of focus here in the industry. So starting my career, been working with manufacturers just on a smaller scale. So here to learn and excited for, the opportunity to be a part of, I just recently joined Kentucky Association Manufacturing as well. So trying to get more involved in that.
Very nice. I think we've covered everyone here. I am so glad that everyone has joined us. We are looking forward to having this chat. If you don't mind, if you're a participant while we're having the conversation here, to mute yourself so that way we don't have any background noises when our speakers are going forward. So I turn it over to our guests, Mark and Kitty. We really appreciate that you both came and agreed to do this with the World Trade Center. Mark and I have known each other for some time, and he was back. He was in Lexington with me in April at the International Trade Certification, and he did a fantastic presentation. And he was kind enough to send me his book, which I enjoyed reading parts of it. And then I reached out to him and I said, I'm looking to do a trade chat of some sort on your area of expertise. And this is when he said, you know, you got to get Kirthi on board here, and she, you know, she's been involved with a number of different things related to the international global marketplace. And so without further ado, and I'm not going to do a formal introduction here, you guys can, you know, fully introduce yourselves and so forth. Take it from here. Thank you.
Great. So maybe why don't I begin, and I'll just I'll be really speaking more about specific type of risk and really narrow focus in foreign exchange. And then in about 15-20 minutes or so, I'll turn it over to Kirthi, who has a much broader like mandate, more issues, more ways of interacting and helping businesses. So maybe I should first begin by telling you that last night I was out with some clients, and part of my job as a strategist is to entertain clients. And so they wanted to go to a steakhouse, and went to a steakhouse, and they wanted to go out for some drink, a cigar bar, went to a cigar bar, and then these guys wanted to go to the racetrack. And I knew that I was going to be speaking here for Kentucky this morning, and I thought, well, what a horse track? I should really, Kentucky's horse country, right? And so I don't know anything about horses, and I was watching things, you know, and then it was like God spoke to me. In the 7th race was a horse called Lucky 7, going off at 7-to-1 odds in the 7th post position. So I bet, like in foreign exchange, we say have a hunch, bet a bunch. So I bet $777 on Lucky 7 at 7-to-1 odds. It came in 7th place. And the reason I like that story is that's how our minds work. We're looking for patterns. And what I'd like to do really is share with you some of the patterns in the global economy, and especially the foreign exchange market. And to think about it is to really think about someone like myself, a liberal arts background, philosophy, history, religion, sociology, and I got involved in the foreign exchange market, and I got involved over 30 years ago, and it still is the most exciting market to me, because one of the reasons it's the biggest. $6.6 trillion a day. That's just a mind-boggling number. Today being Thursday means that the foreign exchange market has already seen roughly $30 trillion of turnover this week alone. And I mention that $30 trillion because that's about the size of the world trade in a year. Global GDP, everything the world produces in a year, is about $100 trillion. We've already done that this month in the foreign exchange market. And so what appeals to me, especially in my younger days, was the sheer size of the market. It's also 24 hours a day. So if you want to buy Tesla stock or Apple stock, the stock market opens up on the East Coast at about 9:30, closes at 4 o'clock in the afternoon. The foreign exchange market is 24 hours a day. My week begins Sunday afternoon when Australia and New Zealand open up. The week doesn't end until Friday, about 5 o'clock, when we're no longer responsible for making prices. 24 hours a day, 6 days a week. It's an incredible market, and it involves everybody. Not only companies, asset managers. If you have a pension fund right now, and in that pension fund, you might have some global stocks or global bonds. You have foreign exchange exposure. Small and medium-sized businesses, I find, are often treated like tourists. You know what happens, you know, right before you go to another country, even Canada or Mexico, and you're at the airport and you decide to convert some money, and they charge you a huge fee to do that. That's what happens, I think, to a lot of small and medium-sized businesses. I'll give you an example. Large businesses, and it's like sort of like houses. The price is found between the spread between the bid and the offer. And what that means in the foreign exchange market, if we're trading, say, the euro, for example, Europe's currency, we trade, commonly you'll see it quoted in hundredths of a penny at a time. A spread then of 1/100th of a cent. And for the large asset managers, it's really 1/1000th of a cent spread between the bid and the offer. But when we look at small and medium-sized businesses, sometimes they're paying 3 and 4% spread. So just like when we go out to the store and we know when we're buying a pair of shoes or a suit or a purse, we know that we're paying a retail price. But money works the same way, and I think we often forget about that. Give you another example about wholesale and retail price of money. Many banks can get money, borrow money from the Federal Reserve for about 2.5%. That's the wholesale price of money today. The retail price of money is what my Visa or MasterCard want to charge me, 21 or 22% annualized, right? So what happens, I think, is just like there's a wholesale and retail market for our goods, there's also a retail and wholesale price for money. And what we try to do is help small and medium-sized businesses move towards that institutional pricing as opposed to retail. And so with that as a background, maybe Omar, if you could show that first slide. What this slide is going to show you is how the central bank, the Federal Reserve, thinks about the dollar. What we're interested in here is called a real. Oh, that's a lot of stuff, huh? I'm sorry. Let me.
Now
maybe,
you got it, right?
Nope. This is an other slide. Maybe you could go to the first one. Further back. I think you got. Yeah, that's it. Oops. One more, I think. One more. Yep, there it is. That's great. So this is a chart. This is really the story of most of our lives. This chart begins off in the early 1970s. We just celebrated the anniversary of the end of Bretton Woods. Remember Bretton Woods from the civics classes? This is the agreement at the end of World War II to try to put the world on a stable financial system. The dollar was pegged to gold, and everything else, all the other currencies, were pegged to the dollar. August 15th, 1971, Nixon closes the gold window. He decouples gold and the dollar and sets off what we consider the modern era of floating exchange rates. Floating exchange rates, you probably hear some people in the Bitcoin space talk about fiat currencies. Fiat means that currencies aren't backed by gold or silver anymore. And so this era, we call it floating exchange rates. It means that they're not backed by gold or silver, and the price can fluctuate widely. So this chart is called the real broad trade weighted dollar. Real means it's been adjusted for inflation. Broad means it includes our major trading, all of our trading partners, not just the big ones. And you can see how we've had 3 big rallies. That first big rally, after Bretton Woods breaks up, it dips, and then we have that big rally. And that really, we call that the Reagan-Volcker dollar rally. And that dollar rally, you can see, historically huge, and it was driven by Ronald Reagan, president, who cut taxes, increased defense spending, increased social spending, while Paul Volcker at the Federal Reserve was raising interest rates because we had double-digit inflation. We're not quite there now, but that was probably the most parallel time to what we have now with the high inflation. So Paul Volcker had the brake on the monetary policy, while President Reagan had the foot on the fiscal accelerator. That is a very bullish, positive policy mix for countries' currencies. And then, excuse me, and then in 1985, they, meaning the major central banks, decided the dollar had gone far enough. And they intervened after meeting at the Plaza Hotel in New York. That Plaza Hotel is now condos. And they sent the dollar down for about a decade. And then we had another dollar rally, the Clinton dollar rally. And that I should say is the Bill Clinton dollar rally, not to get confused with the Hillary Clinton dollar rally. And that Bill Clinton dollar rally was partly the tech bubble. Remember, I had this account around that time. We were getting ready to have my son, and the only thing I bought for him, trying to set up a college account for him, the only thing I bought was Microsoft and Intel. We sort of joked about Wintel. Remember what was happening, or perhaps many of you are too young to remember this. We used to use typewriters, and the businesses took back the typewriters and gave us computers. And so this was the Windows and Intel chips. And it was really the carving out of the internet. I was there when Netscape, the first search engine on the internet, went public. Imagine the internet without a search engine. It's like a dictionary that's not alphabetized. And so we had this huge dollar rally. And the other thing that was happening during this time, like at the Plaza Agreement, there was an effort by the US to talk the dollar down to promote trade. Cheaper dollar meant more exports, and that also forced other countries to adjust their policies accordingly. So whether it was James Baker, who was Reagan's Treasury Secretary, or Lloyd Bentsen, who was also from Texas, was the Clinton's Treasury Secretary, and they both tried to use the dollar as a weapon, telling Japan, Germany, other countries that if they did not let their currencies appreciate, we would make the dollar fall. And Clinton got rid of Lloyd Bentsen and replaced him with Robert Rubin. And that also helped that Clinton dollar rally because Robert Rubin came in and said, he came up with this mantra that the strong dollar is in U.S. interest. And with that, there's been a lot of confusion about what it meant actually. And we had one vice president who said that a strong dollar meant that it was difficult to counterfeit, having nothing to do with the price of it, having to do with the difficulty to counterfeit. But what Robert Rubin meant by a strong dollar policy is that from that point on, roughly 1993, that the U.S. would not use the dollar as a weapon. We would like no longer weaponize the dollar, and that worked. That lasted as a policy until about 2016 or so. And that big dollar rally, that Rubin strong dollar policy and the tech bubble led to this Clinton dollar rally. And that also ended because central banks thought it went too far. And they also intervened in 2000 to drive the dollar down because there was something else that was happening during the late 90s. Europe launched their common currency, the euro. I always thought Europe had a common currency, American Express. But the Europeans decided that they didn't want to have any fluctuation between their currencies. So they had tried, after Bretton Woods broke down, they tried different mechanisms to limit the currency fluctuation until they decided to adopt a common currency. When the common currency was born, it was at about 119, and it fell to about 82.5 cents. And even though what was going on with investors around the world could not get enough of the US technology, the Amazons of the world, the Ciscos, the backbones of the internet, but the Europeans thought we were picking on the euro. And so they helped organize intervention, October 2000, and again drove the dollar down. So you can see we had the Reagan dollar rally, the Clinton dollar rally, both of those ended with intervention and triggered about a 10-year bear market for the dollar. And then after the great financial crisis, which the epicenter was here in the US, it's sort of like the FIFO, right? First in, first out. As the US came out of that great financial crisis early, pursuing aggressive policies, the Federal Reserve was raising rates more aggressively than other countries, sending the dollar sharply higher. So this is the third big dollar rally we've had since the end of Bretton Woods. And it's morphed a little bit. It's covered the Obama administration, Trump, and now into Biden. And some of the same factors have driven it the whole way up, as particularly the aggressiveness of Federal Reserve policy compared to other countries. And so this picture of the dollar, trade weighted adjusted for inflation, shows that the dollar right now, as we speak here today, is essentially as strong as it's been for 20 years. Some currencies, like the Japanese yen, are at 24-year lows. The euro made new 20-year lows earlier this week. So maybe I can show you that next slide, because we ask ourselves, what drives the foreign exchange market? So the next slide, if you could show that, Omar, that should be the Japanese yen and the 10-year rates. Yep, that's perfect. So what this chart shows you, try to answer the question of, well, what drives the dollar? And I want to say that each of the currencies are like their own personalities and have different characteristics. What this chart shows you is a correlation between the Japanese yen and the US 10-year yield. And you can see how a couple of things to be attentive to. One is the correlations move around quite a bit. Secondly, these correlations are still, even when they're low, they're still fairly strong, suggesting that if you want to know where dollar is going to go against the Japanese yen, one of the key factors is where are US interest rates? Are they rising or falling? And because US interest rates are rising lately, that has been a major force lifting the dollar against the Japanese yen. But there's other currencies that have moved by other things. Excuse me. Omar, if you could show the next chart, it should be the Canadian dollar and the S&P 500. Yes. So I picked Canada because I know that in Kentucky, Canada is your single biggest trading partner. Canada absorbs about a quarter of everything Kentucky sells abroad. And so what drives the Canadian dollar? Well, ironically, one of the factors is people's appetite for risk. And how to think about risk, maybe one shorthand for now, we'll get into another layer of meaning. But think about the stock market. When the stock market goes up, investors are regarded to have an active appetite for risk. And when the stock market goes down, they're more afraid. It's almost like that pendulum between fear and greed. And when the stock market rises, people have this appetite for risk. And when the stock market rises, the US stock market rises, the Canadian dollar tends to strengthen. So this is the correlation of the Canadian dollar and the US stock market. And you can see it doesn't move around quite as much as the yen and interest rates do. It stays relatively high. And that tells me that when we're in a bull market in stocks in the US, the Canadian dollar tends to strengthen. And that's important because what it gets our mind to focus on is not so much trade, though it's important for our businesses, but what drives the foreign exchange market, the $6.6 trillion a day market, is the movement of capital, not so much the movement of goods. And so I show you this next chart, which is the Canadian dollar and oil prices. And here too, we're looking at the bottom chart here, the green, and that shows the correlation between the Canadian dollar and oil prices. Many people think of Canada as an oil producer, and they are, but they're also perhaps underappreciated, is they import expensive oil on the East Coast and export their cheap stuff to us through the middle of the country. But oil is a very small part. When you think about the size of the oil market, the oil that Canada buys and sells, compare that to the capital flows going into Canada or leaving Canada, the capital flows swamp the trade flows. And so here, as you remember, the chart of the Canadian dollar and the S&P is much smoother. And here you can see how the correlation moves around quite a bit. Excuse me. I point that out just to illustrate that when you're thinking about what moves the currencies, it varies from currency to currency, but typically, especially for the major currencies, capital flows are more important than trade flows. Maybe I'll show you the next chart, and just to give you a sense, so these are the major currencies, and this is how much they've moved this year already. So you can see that the top one, Norwegian krona, has already moved by 15. I'm sorry, this isn't the right chart. Maybe it's the next chart you can show. There you go. I was going to say the dollar, what all these red lines mean is the dollar has risen against all the major currencies this year. The bottom one is the Japanese yen. It's moved by, the Japanese yen has fallen by over 15%. The euro is down over 12%. And this is important to think about, not just at the magnitude, because in the markets, one of the ways to think about risk is how much something can move. So imagine that many of your businesses have a profit margin of 5 to 10%, which is pretty good for a lot of businesses. You work hard to develop a product or a service that's competitive, that people want. And then what happens? The currency market could completely offset your profits. You're selling your good to Japan, and they give you yen that's fallen 15% in price. So if you're making a 10% profit margin on selling the goods to Japan, if you're lucky, you get the yen and the yen's lost in value, and you turn a profitable business opportunity into a loss because the foreign exchange market takes it away. So the thing to appreciate, I think, is that the currency markets move, and for many small, medium-sized businesses, this is a very significant risk that needs to be managed. Large businesses, the tech companies, the oil companies, many of them hire people from the banks and from the central banks, so the private banks as well as the central banks, to manage their currency risk. They understand the accounting principles, the accounting rules that give companies favorable accounting treatment for hedging their currency risk. And that's really the point, really, right? Is that the foreign exchange market is not just a casino for people to gamble, which they do. It's also a place for businesses to manage their risk, like buying insurance. For example, I was talking to a company that's buying a German machine tool. They don't take delivery of that machine tool for 6 months. They have to pay half the money up front, half the money upon delivery. Should they just let the markets determine what they pay for that second payment, that second half? Or can they lock in the price today for that future? And that's what they can do. The foreign exchange market, in effect, has insurance products that let businesses lock in the prices for the future. And that, in some ways, it works the same way with revenue. You sold a good overseas. Maybe you sold it to Canada. And they owe you the money. And how can you protect the value of the money so when you do get those Canadian dollars or Japanese yen or British pounds, you can count on their value when you convert them into dollars for your own purposes, for accounting purposes, because maybe you're a dollar functional company. And so the point of this chart is just to show you that the foreign exchange market, the movement can be quite substantial. And it's a risk that can turn a profitable transaction into a losing proposition. And I have one more slide for you, this next slide. And so, excuse me, this next slide is really just, when we talk about how much that currency can move, this is the mathematical expression of it. Perhaps you remember from calculus class or stats class that we talk about standard deviations, right? How much something moves like around a mean over time. And the foreign exchange market, volatility captures that movement. This is an annualized rate of change, and it's how much the currency can move. And what that volatility shows you, that's how we think about that risk, is that volatility is substantial, which means the risk is substantial, that you don't get as much money as you expect when you sell a good, or you pay more when you collect money from somebody. And so, so again, I want to just leave you with a few really basic ideas. And the foreign exchange market, I spent my career in foreign exchange. I still find it, when you think about what pushes the price of Apple stock around, you might talk about maybe Apple products. You might talk about the strength of the U.S. economy. You might talk about Apple's competitors. but broadly speaking, there's a handful of variables. In the foreign exchange market, in which how does one get that foreign exchange exposure? By buying or selling something outside of your own country. And I know there's some people who, when I talk about this, they say, well, they only transact in US dollars. They don't have any currency risk. And I think that's that's too simple of an approach. Imagine this. You are producing a product in the US. It's a good, high quality product. And your only competition is in Japan. And now what's happened in this past year is that Japanese competition just got a 15% leg up on you because their currency is devalued. So yes, you do not have direct currency exposure, but because of your competition, they do. And they've gotten an advantage because their currency is devalued and you haven't. That is to say, the dollar is strong and the yen is weak. And this year has been particularly difficult because the dollar strengthened against almost all of the world's currencies. And so again, I leave you with the idea that the foreign exchange market poses a risk for businesses, but the risk can be managed. And it's not just, I think we heard from someone who joined here who's on from Fifth Third. Fifth Third is also based in Ohio, like Bannockburn is, and they also have services like most banks do to manage currency risk, to have professional people helping small, medium-sized businesses manage their foreign exchange exposure. And so I leave you with that. And now I just turn it to Kirti for a broader think through about some other risks and challenges for businesses.
Thank you, Mark. That was so insightful. A perfect segue into, some of the challenges that small businesses face in the US, privately held small and medium businesses. I thought this slide is kind of a good representation. We bucketed it into 4 buckets. You just gave the segue for money, and then men, material, and mandates like regulatory and compliance. So, let's start with money. Again, Mark, it was a very insightful discussion. So money is the very lifeblood of commerce, as we all know. Almost 2 years into the COVID-19 pandemic, many small businesses are still struggling to arrange short-term funding to meet expenses like even payroll, which is critical. While financial assistance for those impacted by the crisis has ended, some of the hardest hit industries, including gyms, hotels, and restaurants, are pushing for more relief. For many, the Omicron surge dealt a big blow. So during the pandemic, bankers and lenders processed large loans for wealthy customers. We heard that, it was splashed all across the media. But being advisors to small businesses, we felt that, that the smaller loans for the most neediest small businesses took a long time. We saw many small businesses couldn't get their loan requests submitted before the money dried up due to flaky online portals and backed up queues. So the key to access to these relief funds was the banking relationships that these businesses held. So my point is, when choosing a bank, consider its experience and resources. Your banking relationship should go beyond providing transactional activities and lending options to offer you the support, services, and flexibility you need to help your business grow. A bank that offers tailored services to support your specific business needs can be a game changer. Convenience and security are crucial, especially if you have operations outside the United States. Banks with specialized financial teams that regularly work with various business models, growth plans, and operational challenges can offer valuable insights. So your banking professional can also be a significant resource for client referrals, warm leads, and networking opportunities. We're seeing that more and more. Additionally, your bank may offer tools and services to help streamline your business operations, such as integrating with your accounting software, recruiting, payroll, and bill payments, improving the cash flow management, and aligning your banking and tax goals. So the key takeaway from this bucket, I think, is think of your banker as a valuable partner and not just a resource to make and receive payments. The next bucket, right? Men, or Akka talent. Before, we would bring talent to work. Now you can take work to talent. So since March 2020, our workforce has undergone several dramatic short and long-term shifts, ranging from the sudden necessary move to remote work to larger questions surrounding work-life balance and the overall relationship between employers and talent. So I think there are 4 important key takeaways post-COVID. One, that technology and remote work has talent geographically dispersed. If you want talent that is in a different country or location, you can now, through technology, take work to that person, develop that person, and retain that person. The trend was there for a while, but COVID accelerated this trend. But this also opens up what some call a compliance nightmare. So as small and medium-sized businesses, you need to evaluate the income, franchise, sales and use, payroll, and other tax implications of having employees work within a particular US jurisdiction. Also correctly classifying independent contractors versus employees and putting agreements in place to reflect those relationships. Secondly, we're seeing that employees have more control over their work now, how they work and where they work. If you're a high potential employee or a high performer, you are controlling the conversation. You're dictating the terms. Employers are now listening. The third one is organizational culture. Businesses big and small are grappling with this question. What is organizational culture now? Culture had been people together in meetings in the same building, but that's disappearing. The organizational culture is changing and evolving. We still don't know what the new culture looks like. We are moving from a traditional leadership model to virtual and hybrid. How do you develop virtual leaders? And who will be able to manage and engage a geographically dispersed workforce and talent through technology? Talent analytics will play a larger role. Everything is being measured all of the time. The question is, what do we do with this data? Real-time decisions will be increasingly made on data. And last, but certainly not the least, the great resignation. I think we've heard enough of that word. But I think the talent shortage is there all the time. One of the disconnects there is how fast jobs are changing and how quickly people can learn and develop. What the pandemic did was move people indoors and remotely to work, and a lot of social and psychological aspects came in. Working remotely has caused a lot of stress and burnout. People end up working more and questioning the meaning of their work. Most homes are not designed for working from home. Most families are not used to spending so much time together. People need space, more specifically Gen Y and Gen Z. For any organization, retention is critical, and retaining talent becomes a key strategy. You have to pay attention to each employee to see how the organization can help them move their career forward, almost like customizing careers for your employees. When you start the conversation from that angle, people get motivated, engaged, committed, and eventually stay. The key takeaway from this bucket is, with the workforce undergoing several dramatic short and long-term shifts, the key is to make sure your business always has the right leaders and talents in place should a change happen quickly. By failing to create an orderly plan for succession, your company may not get a second chance if it doesn't adapt immediately after a key player leaves the company. Moving on to material or supply chain, as we are hearing so often. The Russia-Ukraine conflict, wider geopolitical implications, and renewed COVID-19 lockdowns in China have compounded an already bleak global supply chain situation. Existing restrictions imposed on Russia and the potential for further restrictions continue to impact fuel costs, as we all see when we drive around, contributing to the wider supply chain crisis. While there had been signs of easing supply chain disruption early in 2022, evolving global factors and geopolitics are causing new risks and pockets of stress. So for us, potential risk factors to keep in mind include possible rebound in US port congestion as and when Chinese output increases, or relates to the upcoming port worker labor negotiations happening. Spillover impacts from the Russia-Ukraine conflict at northern European ports, which were facing congestion issues prior to the conflict. Limitations on air freight transportation, particularly along the Asia-Europe lane, where planes would usually travel through the Russian airspace. Again, COVID-19 lockdowns in China, particularly in Shanghai, where reduced manufacturing, a shortage for truck drivers. I know that we have a guest here who's in this business, and various other factors are damaging an already fragile supply chain. And finally, disruptions to rail freight, with the overland rail link from China to Europe faced with uncertainty over whether cargo can pass through Russia, as well as hidden costs such as insurance that Mark alluded to. So with all these, what should we be keeping in mind? Like, where will these effects be felt the most, the supply chain shortage effects? Metals and mining, aluminum will probably face the most significant and immediate disruption risk, and this will impact critical industries like packaging, transport, renewable energy infrastructure, and wiring. Chemical supplies. The supply of fertilizers is likely to be impacted as Russia is very significant in this space. So that can result in price hikes and eventually our food prices going up. Automotive sector, we have all seen that in the news. It's facing a disruption due to rising costs and availability of nickel, copper, platinum group metals, aluminum, and steel products. And semiconductors, again, something we read about a lot and was seen in the media and news. Shortages in semiconductor industry are not new, or surprisingly, they are cyclical in nature. Shortages can be caused by natural disasters, variations in supply of semiconductor material, changing economic conditions, so various things. And that cycle typically tends to be short-lived, 6 months to a year. But what we are seeing now, the current chip shortage, is an unprecedented deviation to that trend. Over the last decade, the market has seen many businesses in semiconductors moving towards just-in-time inventory. So, that usually works when there is no supply chain problems. Most semiconductor manufacturing facilities called fabs operate at around 80% utilization and modify this operating capacity to accommodate fluctuations in demand. But the unpredictable events of the past 2 years have disrupted this operating rhythm, presenting businesses with the supply chain shortages that they are facing today. And last but not the least, technology. That sector will face a huge impact of the supply chain disruption. Industry-wide silicon chip shortage and disruptions related to COVID-19 lockdowns in China have left the technology sector facing renewed supply constraints. For instance, even big giants like Apple, the main focus is still on supply, despite concerns about inflation affecting consumer purchases and the pausing of sales in Russia, which will impact year-over growth by around 150 basis points. But if you just see in the first quarter of 2022, Apple saw a 26% quarter-over-quarter drop in product sales, which, with worse still to come. So it will be interesting to keep an eye on what this all means to small and medium-term businesses too, and plan ahead. So what would we need to happen to solve these ongoing supply chain issues? Do we see any relief in sight? The solution seems likely to be either an increase in capacity or a fall in demand. On the capacity side, increased US trucking capacity and reduced worker restrictions related to COVID-19 should help. And on the demand side, the recovery in inventories, as we are seeing in many importing countries, should help. And also a shift in the mix of consumer spending back to discretionary services could also help. So key takeaway from this bucket is businesses, especially privately held small and medium, can optimize their supply chain by forecasting demand accurately, making smart purchase decisions, finding alternative suppliers, and even looking at outsourcing their supply chain management to 3PLs. We're seeing a huge increase in that space. Last, the most fun part, mandates or regulatory and compliance requirements in the US. The American government structure is layered and complex, with laws and regulations that cross the federal government, 50 state governments, cities and counties, statutes. So they're all nuanced and may differ depending on your location. Even more complex is the sales tax jurisdiction, a system of financial regulation that creates a web of requirements and compliance needs. State and local taxes are generally not covered by or preempted by international tax treaties for those of you having overseas operations. Here is why having a plan and experienced advisors is critical. Many of you would have heard about the Wayfair case, right? The Wayfair ruling indicates that physical presence is no longer required for a state to impose sales and use tax on a remote seller. This literally changed the landscape of sales tax. This decision impacts Nexus and therefore impacts tax compliance for any organization operating across state borders, let alone international borders. Yet many companies are not up to date on the rules in each state, and they can vary greatly. While each state may have its own rules, one thing is quite clear: every seller must review and address its sales tax obligations. State tax changes can be overwhelming, so few tips to manage this is do a Wayfair checkup. that can help you understand your sales tax exposure from economic nexus, and a historical nexus study can help guide your compliance decisions surrounding both sales tax and other state and local taxes. So key takeaway here is for some companies, outsourcing your tax compliance obligations may allow you to refocus your time on value-added activities while letting the experts handle it and guide you. I think with that, we open it up for questions, Omar and Mark.
Yes, thank you so much. The opportunity here to hear you both present, the exciting part is, when you're talking, you get us to reflect on a lot of things and you get us to evaluate a lot of key takeaways. I have some questions, but I'm going to hold my questions till later. I'm going to ask the participants here to chime in with their questions. So please feel free to chime in with any questions for our speakers here.
Hi, this is Sarah. I'll jump in with a quick question. In the course of my job, which is helping U.S. companies export, primarily small and medium-sized companies, I don't typically talk a lot about foreign exchange. Am I doing them a disservice by not talking about foreign exchange, or are they missing an opportunity by demanding payment only in U.S. dollars? I guess that's two questions.
Same price, doesn't matter, right? I think that there's two ways. I think that that it seems to me that even if, like, of course, I mean, in the United States, with the dollar being the key currency in the world, of course, our businesses, we prefer generally to trade just in U.S. dollars, to make our purchases in dollars. It makes things a lot simpler. But I think that, so I think on one level, for small and medium-sized businesses to transact in U.S. dollars is a big advantage. It's an advantage that many other countries do not have. But at the same time, I think that it might expose, if it just stops there, I think that what happens is they don't some businesses might not appreciate the competitive advantage that other countries have by having so for example, you say, well, the dollar, we're only going to transact in dollars, but the people are going to have to buy our product who are going to pay us in dollars. Is that we set the price in dollars, but it might cost them more Canadian dollars or more Mexican pesos to make that purchase. And so it might not help us to Kathy's point about trying to understand and have greater transparency and visibility about costs. That it might not be it might give a say a less than whole picture of the kind of competition that the business faces. But I think that you're right that at day one, if you're going to begin selling overseas or selling to outside the United States, that staying in the U.S. dollar, it makes it a bit easier. So that might be like they say, right? You have to walk before you run. And so I think that what you're doing, to me, is helping people learn to walk. And later they'll have to run because the world is moving quickly on them.
Excellent advice. Thank you very much, Mark. Appreciate it.
Mark, if I may chime in, Sarah, what we do is when businesses come in or when they're thinking of crossing borders, we ask them, will you have significant foreign exchange transactions? Most often, as Mark said, when they're learning to crawl and walk, it's no, but we keep in touch. Like if it's increasing significantly, it's time to start planning your foreign exchange, like how the transactions and leverage and all of that.
Mm-hmm. Would you say there's and maybe this varies industry to industry, but would you say there's sort of a minimum amount over the course of a year that would cause you to advise a client to look into accepting foreign currency or doing something differently than only pricing in U.S. dollars?
My answer, I think, would be that it does vary, not so much by industry, I think, but as by the company level. That how much risk can you have and still sleep at night?
Yeah.
Okay.
And so I once talked to this one company that was saying that they had they were collecting a dividend from a New Zealand subsidiary. And so they would be accumulating these New Zealand dollars. And I said, well, what do you do with them? And they told me, well, when it gets to be a lot, we convert them. Excuse me. And so I think that's like the general attitude is when something becomes substantial, which could vary. And that's the other point I maybe should say about foreign exchange market. When I first got involved, one needed $1 million transaction to make it worthwhile. But there's been a democratization, if you will, of the markets. And I know that Bannockburn, but other companies as well, will do transactions for businesses, much smaller amounts, partly to Kathy's point about the overall relationship that a financial institution has with the corporate client. That they might do it as a service, just like they might have a low-priced wiring service or an ACH function. That businesses now can transact in the foreign exchange market regardless of size.
Okay, very good. Thank you all very much for your insights and for answering my questions. Yeah.
Okay, any other questions? Okay, my question is much broader in thinking, and that is, the insight that you've given us about where the dollar is and how it's moved, and then your discussion about supply chain, talent, and things of that nature. I would like to pose a question as it relates to globalization. Are we moving in a direction where, as a country, we're embracing globalization and we've done a very good job of being a global player? Or are we moving in a direction where there's more protectionism happening and more of our businesses are coming back to setting up their operation here in the US and less in terms of manufacturing? And the reason I say this is I've been at a seminar recently and I've heard someone talk at an export seminar, and I've heard someone said, we only care about our domestic market. That's our bread and butter. Exporting is not as important. And then I heard another manufacturer talk about how at one point they had a huge export business, but because of what has happened in Europe and the euro and the inflation and things of that nature, their export business just disappeared from that perspective. So I'd like to hear your general views on globalization versus protectionism, if you will.
That is such an amazing question, Omar. And Mark and I picked up a new term in Select USA, organized by the US Department of Commerce. I see Sarah is here. The term is glocalization. I think that's where we are headed towards. A beautiful mixture of globalization, which is going nowhere. You cannot afford to ignore that, and localization. So to give you an example in the talent space, you are leveraging global talent, but to elevate your local talent. It's not like you're sending away jobs to cheaper countries. That's not the point there. The point is, okay, my people on my team don't want to do these tasks. They don't think it's value add. How do I elevate them? By leveraging global talent. So people seem to be very open to that. It's not like an extreme protectionism or, let's just move all jobs overseas and fire our staff. It's a happy medium of globalization.
Yeah, it's fascinating, huh? I mean, Adam Smith, sort of considered the father of capitalism, writes this book, right? The Origins and the Wealth of Nations, and he takes people through a pin factory. And the pin factory, he shows how all the different, like the division of labor, all the different smaller tasks can be distributed. Even back then, 1776, to, excuse me, can be distributed around the world. In our lifetime, Milton Friedman, a Chicago-based economist, did basically the same thing, but looking at how a pencil is made. And I think that, Kathy's point about sort of marking this period of post-COVID is very important. During COVID, we found that we in the United States were very dependent upon other countries for masks, for other like personal protection equipment, right? we find that even when it comes to like vitamins and drugs, we get so much from overseas, and we want to become more dependent. We want to become more independent, produce them ourselves. In the U.S., there's a big push now to produce more semiconductors, more of the fabrication facilities here in the States. Imagine what China must be experiencing. There's a duopoly on operating systems, right? OIS and Android, and yet China is held to this duopoly held in the United States. It's not in their interest to do that either, and so I think that that there is some elements of whether it's I've heard called a reshoring, onshoring, nearshoring, friendshoring. That maybe that the kind of globalization that takes place, it seems like it's one of those things like that philosopher said about how you could never step in the same river twice. That globalization is always moving and always transforming. And I think that this next version of it might be a little bit more featured by regionalization. So when companies are trying to move out of China, some of them come to the United States, some go to Mexico, Colombia, where we also have a trade agreement with. Same thing that Europe is doing. I wonder if in going forward, that how the U.S. relates with South America and Central America, how Europe interacts with Northern Africa, Central Europe, how China and Japan interact with a lot of those small Southeast Asian countries. That how we, rather than being major country to major country, maybe it's more of a North-South integration and wanting to have these important products. Kirti was talking about semiconductor chips and the things you need to make them. So if we want to have more semiconductor chips being fabricated in the U.S., maybe we need more neon too, which is used to like etch into the semiconductor chips. So I think that globalization is moving. It's an evolving development, but I do think it's changing, and I think that COVID and the geopolitics has woken us up to some greater risks that we might not have been appreciative of before. As Kirti was mentioning, a lot of our models really presuppose a certain level of stability. And it seems that if anything, the world economy is not stable anymore.
Yep. Thank you, Mark. It seems that we have Kirti has dropped off, but I guess we are at the end here. And just let me quickly, on behalf of the Kentucky World Trade Center and the participants here, thank you, Mark and Kirti, for a very, very insightful discussion and a trade chat. It definitely summarized a lot of, I don't want to say the issues, I want to say the opportunities that we're facing day to day, and these opportunities are definitely the position of the dollar and as it relates to the inflation, the trade supply issues, as well as talent related issues, and then finally this position of where we look at globalization and localization and things of that nature. So with that, please stay tuned for our next trade chat. Our next trade chat is going to be focused on relations between Kentucky and Ecuador on September the 29th. And then we will be hosting another international trade certification seminar at the beginning of November. And we look forward to having you attend some of these things. Thank you, Mark. Thank you, participants. You all have a wonderful, wonderful, wonderful Thursday.